Welcome everyone to a new video. In today's video we dive further into the deeper issues surrounding the economy and the markets, where last week I told you about inflation and what you need to start paying attention to if you want to earn more than the growth of central bank money, the real denominator. Today we're going to talk about the current explosive rise in yields and the impact it has on the currencies and Bitcoin. So if you can appreciate this, please leave a like on this video and don't forget to subscribe to this channel. In addition to these videos, I also went live often this week to discuss both the market and the FOMC with you, and next week on Monday and Thursday I'll be live on 7 PM again. If you like what we do, we also have a trade letter and premium membership, which both can be tested for 1 week for free. The links in the description gives you all the information you need to join for free. Back to today's video, I'll show you why the rise in yields is unsustainable because of the inevitable destruction of the economy, and next to that, also some data points to know what to look out for. And I think that it should not come as a surprise to you at the moment that we are into an economic low. Indeed, to get out of a low you must first move toward rock bottom, and we are moving towards that in a fees rate. This is scary and it comes with some scary charts, and here are some examples. We are starting with something special, which is the housing market, in which we see sales plundering, mortgage application declining, supply of new homes extremely increasing, and 30-year mortgages up 90% year on year. This is well shown in the chart next to me with the collapsing home builder sentiment and where the mortgage rates are moving. And if you combine that with the fact that saving rates are collapsing, we know that people have been living on the brink of collapse. The following image shows that households have been feasting on savings, but which are now virtually depleted. This and many other charts on the current economic status together indicate an extremely poor economic situation around consumer buying conditions, which is pretty much the worst in 40 years. And this while total global debt is enormous. I've talked about it many times on this channel, but we are in an economic malaise where all the different facets of the economy are interconnected, and therefore almost everything reacts to macro conditions, CPI and FOMC. And that this situation is unprecedented, you can see in the latest chart, which shows you the economic tightening compared to recent years. The reason I show the housing market situation is because it is one of the largest financial asset classes, and it therefore needs more time to go from bullish to bearish than the cryptocurrency market needs. As such, the housing market can be seen as a good stage reflection of the economy. Remember the distinction we always make between the economy and the markets. The economy is now, the markets are the future. And to say that the economy is doing badly is pretty much an understatement. Virtually all asset classes are reacting to economic data, which really only takes care of one thing right now, which is the rise in yields around the world, because they are all still seen as the least risk. For starters, let's look at the situation in America. In the next chart, I have shown the data of the DXY, the 2-year yields and the 10-year yields in one chart. We see an incredible increase in all three charts in a relatively very short period of time. This is a situational chart of the economy. The huge increase in yields destroys interest in other asset classes and indicates a clear liquidity problem in the markets. In addition, a rise in yields negatively impacts the CB balance sheet. Normally this is not a problem as long as the currency can bear the burden, as the USD does in America, but now it's different. The increase in strength of the USD has a very strong negative impact on the currencies of all other countries in the world, which in its own way therefore cannot cope with the rise in yields. An example is the Great Britain, and the British pound has lost 27% in 15 months. A similar event is taking place in Japan. Yields rise dramatically and the Japanese yen loses enormous value against the dollar in a short period of time, or in Germany with the huge decline of the euro. And in the next image, from Monday, September 26th, we see a rise of basically every yield across the globe, with Great Britain cautiously rising 7 and 15% in one day. It cannot happen, and therefore something needs to change, and now a few countries and banks have been stepping in to fight the weakening of their own currency. Bank of England announced a buyback program for their bonds, which essentially means that they will be using QE instead of QT, which is a complete change of their policy. Next to that, the Bank of Japan did the same, and it's just a matter of time until Europe is stepping in. However, as we know, the yields have been going up vertically in the past year, resulting into markets collapsing and putting a tremendous pressure on our economic system, as the yields in Great Britain, for instance, have been swiftly running from 2 to 5% in less than a year. Let's discuss why this is important. Remember last week when I talked about how to outperform inflation? In the world of QT, all asset classes trended to a correlation of about 1 to 1. This means that almost all assets will react similarly to macroeconomic events. This correlation boils down to the fact that if the balance sheet grows, then assets grow in value. If the balance sheet shrinks, then assets fall in value, which gives us the formula: global liquidity is the value change of asset classes. Markets respond to liquidity. If this liquidity is taken away, then yields shoot up in conjunction with the global reserve currency. Risk assets react negatively to this and trend downward, an inverse correlation. This looks like this. In the chart you see Bitcoin in orange, responding to the DXY, the 2-year and 10-year yields. With this negative feedback loop, the rise in yields will continue and resolve into a currency collapse around the world. The central banks need to step in to strengthen their own currency, but most likely this won't be enough. The increase in strength of the USD will continue until something breaks or until central banks step in with, say, yield curve control or providing liquidity. We are approaching the end of the dollar era, and this will not be determined by the dollar becoming worthless, but by the dollar becoming too strong against the other currencies in the function of a world reserve currency. It will be almost useless for the other countries to calculate in dollars. With this inverse correlation of risk assets to yields and currencies, which in turn are directly linked to global liquidity, we are stuck with the situation until we see a change in policy from the Fed in particular. In the latest readings, Powell keeps talking about bringing inflation down to 2%. However, the reality is that bringing inflation down to 2% will cause destruction of the economy, an unattainable goal if you care about the population. With the outlook that the economic data in the coming weeks will really be very dramatic, the Fed will soon have to start making a choice between fighting inflation or preserving the economy. My bias is towards the latter, and as we know, data is leading. In today's video, I took you through the current economic situation and why it matters if you are an investor in the crypto market. We look at multiple factors, but currently currencies and yields reflect the status of the economy. So stay tuned to the data that can influence these charts, and of course we will be keeping you posted. Thanks for watching. Make sure to hit that like button and subscribe to this channel, and don't forget, don't do stupid shit, stay calm and avoid emotional trading. Ciao!